Two people retire in the same calendar year. They have the same job titles, the same salaries, and the exact same amount sitting in their 401k accounts. On paper, their futures look identical, but 5 years into the future, one of them has $50,000, $80,000, or even $150,000 more in their pocket than the other. The difference wasn't their investment strategy. It wasn't their lifestyle. The difference was simply the month they chose to walk away from their desk for the last time. Most people spend decades obsessing over how much they save, but they spend almost zero time thinking about when they actually stop. We think about years, not months. We think about milestones, not cycles. But picking the wrong retirement month can quietly bleed your net worth through unnecessary taxes, lost benefits, and poor investment timing. Today, we are breaking down why your retirement date is a massive financial decision, not just a lifestyle one. We will look at the smartest months to quit, the absolute worst months to say goodbye, and how to choose your specific date strategically so you don't leave a small fortune on the table. When we talk about retirement timing, most people think about their age. They think about turning 62, 65, or 67. They think about the year they want to be done with the daily grind. Usually that decision is driven by things that have nothing to do with money. Maybe it's a birthday that feels like a milestone. Maybe it's a feeling of burnout after a particularly long project. Maybe it's a random company deadline or just the desire to be free by the time summer starts. But retirement isn't just a date on a calendar. It is a complex financial transaction. When you stop working, you are flipping a series of switches that control your taxes, your Social Security benefits, your healthcare costs, and your investment withdrawals. If you flip those switches in the wrong order or at the wrong time of year, you create friction. That friction costs money. Transitioning from a steady paycheck to a portfolio-based income requires a high level of strategic retirement month planning. The reality is that the month you pick dictates your tax bracket for the most important year of your life. It dictates your insurance coverage. It even dictates how much your Social Security checks will be for the rest of your life. Let's start with the biggest hidden cost that catches almost every new retiree off guard: the tax trap. The first year of your retirement is almost always your highest tax year, and the reason is simpler than you think. If you retire mid-year, say in June or July, you have already earned half of your annual salary. That salary has likely pushed you into a specific tax bracket. If you then start taking large withdrawals from your 401k or IRA to fund your new lifestyle in August, that withdrawal income is stacked on top of the salary you already earned. You are effectively paying your highest marginal tax rate on those first retirement distributions. Imagine you earn $80,000 in the first 6 months of the year. You're already in a solid tax bracket. If you retire and pull out another $40,000 to live on, that $40,000 is taxed at your peak rate. However, if you had waited until January to retire, your total income for that new year would start at zero. Your withdrawals would then be taxed starting at the lowest brackets, potentially saving you tens of thousands of dollars in that first transition year. Working 12 months and then retiring on January 1st creates a clean tax year. It separates your high earning years from your high withdrawal years. The mid-year retirement is a tax spike that most people don't see coming until they file their returns the following April. But taxes are only the beginning of the problem. The second hidden cost involves Social Security timing mistakes. Most people know that claiming Social Security early reduces their monthly check, but they don't realize that the specific month you claim matters just as much as the year. Your benefits are calculated based on your age in months, not just years. If you retire in December, but wait until January to claim your benefits, you might be missing out on a specific cost of living adjustment or a monthly increment that adds up over 20 or 30 years. Conversely, if you retire early in the year and claim benefits while you still have high earnings from your final months of work, you might hit the Social Security earnings test limit. This could result in the government temporarily withholding your benefits because you earned too much in the same year you started collecting. This creates a massive cash flow crunch. Retiring in December versus January can result in losing nearly a full year of optimized income, depending on how your birth month aligns with the Social Security Administration's payment cycles. Every month you delay past your full retirement age adds about 2/3 of 1% to your future check. If you retire in the wrong month and claim too early, you are locking in a lower rate forever. Then we have to talk about something more volatile: market timing risk. In the world of finance, we call this sequence of returns risk. This is the danger that the stock market will experience a significant downturn in the very first years of your retirement. When you are working, a market crash is just a sale on stocks. But when you are retired and living off your portfolio, a market crash is a disaster. If you retire in a month where the market is peaking, and then it drops 20% in your first 6 months of freedom, you are forced to sell your investments at the bottom to pay for your groceries and housing. This depletes your portfolio much faster than if the market had stayed flat. Two retirees could start with the exact same amount of money, but if one retires right before a downturn and the other retires right after a recovery, the one who retired before the downturn could run out of money 10 years sooner. The first 2 to 3 years of your retirement matter more than the next 20 combined. By choosing a retirement month strategically, you can ensure you have enough cash or liquid assets to avoid selling during a dip. But that requires looking at the economic climate of the month you choose to walk away. Beyond the markets, there is the massive hurdle of health insurance timing. If you are retiring before age 65, you aren't yet eligible for Medicare. This means you need a bridge. Retiring at the wrong time of year can mean paying for extra months of incredibly expensive private insurance or COBRA. Even worse, if you retire in November, you might have already hit your health insurance deductible for the year. If you start a new plan in January, that deductible resets to zero. If you have a major medical procedure planned, doing it in December while you're still on your employer's plan is a smart move. Retiring in January allows you to align your new insurance deductible with the full calendar year. If you retire in May, you might find yourself in a coverage gap where you are paying full private premiums while also having to meet a new deductible mid-year. This can easily cost you $5,000 to $10,000 in a matter of months. What are the finest retirement months? The best time is usually January. A new tax year begins on January 1st when you retire. Retirement disbursements will be your only income for the year, keeping you in the lowest tax bracket. It also matches insurance cycles and Medicare enrollment windows. Another good choice is late December. This lets you get your full year's income, end-of-year bonuses, and maximize your 401k contributions. Most significantly, it prevents you from losing vacation time or vested benefits. Finally, check when company bonuses or stock options vest. If your firm distributes incentives in March, retiring in February is a huge financial blunder. Returning a year-earned check is like giving it back. The greatest retirement month is rarely your birthday. It optimizes cash inflow and minimizes taxes. June and July retirements are hardest. In the tax sandwich we discussed, salaries and withdrawals produce a substantial tax burden. Benefit vesting is also mistimed. Panics in the market are bad for retirement. Stress-related quitting locks in portfolio losses and starts retirement at a loss. Because of this, people must work 3 years later. Your retirement month should be decided in 4 steps. Check your tax brackets first. Estimate annual income and withdrawals. If the number is high, move it to January. Recognize your advantages. Your employee handbook. Bonuses paid when? When does vacation reset? Your stock grants vest when? Nobody leaves money. Social Security preparation is third. Compare your full retirement age and birth month to the year. Step 4. Healthcare planning. When does your employer coverage end and your new coverage begin? The biggest mistake is retiring emotionally rather than wisely. A bad week at work leads them to examine their 401k and quit. Sometimes they follow a coworker retiring in April and think it's a good time. Permanent retirement. Timing errors are costly and often permanent. Only one retirement. Smart retirement saves years, not just hundreds. Building your nest egg took 30 to 40 years. Since you didn't wait months, don't allow the calendar take over. Do the math, consider the taxes, and pick a month that fits your budget, not your mood. That increases your retirement security, confidence, and bank account money. Same savings, same person, different result. Retirement timing crucial. Retirement.